Nvidia entered a market it was never supposed to compete in, and the capital reaction confirmed that the market understood the stakes immediately. At Computex 2026 in Taipei, Jensen Huang unveiled the RTX Spark, a combined Grace CPU and Blackwell GPU on a single chip, co-developed with MediaTek, built into the new Microsoft Surface Laptop Ultra. Qualcomm fell nearly 10% in pre-market trading. Intel shed more than 6.5%. AMD dropped over 4%. The surface explanation, chip competition, does not account for the magnitude of those moves. The real repricing is about what Nvidia's Vera CPU architecture means for the total addressable market. Huang said during the May earnings call that Vera gives Nvidia access to a new $200 billion CPU market. Until this week, that was forward guidance. The Computex announcement converted it into a product. The positioning pressure on AMD and Qualcomm is not just competitive. Both companies had been priced on the assumption that Nvidia's dominance was confined to data center GPUs, a contained threat. RTX Spark breaks that containment. Retail flow into Qualcomm had accumulated on the thesis that on-device AI processing was Qualcomm's structural moat on Windows devices. That position is now being unwound, interpreted from Qualcomm's intraday volume running well above its 3-month average. ARM holdings surged 14.5%. The Nvidia chip uses ARM architecture, so the flow that exited AMD and Intel did not simply vanish, but rotated into the intellectual property layer that now sits beneath Nvidia's entire PC stack. Microsoft gained over 3%, reflecting that Windows on ARM just received its most credible hardware partner. Alphabet's separate announcement that it would raise $80 billion to fund AI infrastructure, including a $10 billion anchor from Berkshire Hathaway, confirms the demand environment that makes Nvidia's PC push rational. When hyperscalers are spending $180 to $190 billion on capex this year alone, the pull-through into every layer of the compute stack, including edge devices that can run AI agents locally, is not speculative. It is already being funded. What the RTX Spark announcement leaves unresolved is the supply chain constraint. A chip that runs 120 billion parameter models locally requires unified memory architectures that go far beyond standard LPDDR configurations. The Surface Laptop Ultra supports up to 128 gigabytes of unified memory, a specification that requires energy inputs at the manufacturing and operational level that the market has not yet priced at the asset level closest to that constraint. The energy constraint that Nvidia's AI compute ambitions expose leads directly to a Canadian asset that moved on the same day the RTX Spark was announced, and the connection is not coincidental. Cameco and Orano reached agreement to jointly acquire TEPCO Resources' 5% participating interest in the Cigar Lake joint venture for approximately $115.75 million, raising Cameco's stake to 57.418% and Orano's to 42.2582%, giving the two partners full ownership of the world's highest-grade uranium mine. Cigar Lake holds 172.4 million pounds of uranium reserves, produces between 17.5 and 18 million pounds annually, and sits in northern Saskatchewan, with a mine life extended to 2036 through ongoing capital investment in Cigar Lake extension infrastructure. The TEPCO exit, a Japanese utility shedding a small participating interest, was interpreted by Cameco CEO Tim Gitzel as confirmation that scarce, licensed, permitted assets are becoming more valuable, not less, as global nuclear energy generation ambitions expand. The capital flow visible here is institutional accumulation in a supply-constrained commodity ahead of a demand inflection that is now being funded by hyperscaler capex commitments. National Bank described the acquisition as modestly positive, a characterization that underestimates the structural signal. When Alphabet announces $80 billion in AI infrastructure spending and Nvidia announces a $200 billion CPU market entry in the same week, the energy required to power the data centers processing those workloads does not decrease. It accelerates. Cameco shares slipped 1% on the day of the announcement, interpreted from price action alone, since no institutional flow data was disclosed. That reaction reflects the market pricing the acquisition cost, $115.75 million against a $47.6 billion market cap, rather than the strategic optionality of consolidating the Cigar Lake ownership structure before the nuclear energy demand cycle matures. The divergence between the announcement's strategic weight and the market's price action response is the locus of the positioning question that remains open. The verification benchmark is Cigar Lake's Q3 2026 production figures, which will confirm whether the 17.5 to 18 million pound annual output guidance holds through the capital transition period. If uranium spot prices hold above current levels as AI data center energy demand continues to be funded through hyperscaler capex commitments, the 1% dip on announcement day will read as a cost basis for institutional accumulation, rather than a signal of fundamental concern. The position breaks if uranium spot prices fall materially as Iran nuclear deal negotiations produce supply-side relief. That is the specific threshold that would shift the capital flow direction in Cameco's ownership consolidation from strategic timing to early positioning. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.